Well, thank you very, very much. I really appreciate that warm, introduction, and I appreciate all of you being here so late in the day with us. And really just appreciate MarketFest, Winvesting, putting on a great show today for all of you. So hopefully I can pull up the rear and give you guys some great information to take away and make it worth your while to be here late in the day with us. So as we go ahead and we get started, I'd just like to remind people, of course, trading involves risk, not just reward. I'm sure the guys probably covered that with you earlier today, but I like to remind people because, as they mentioned, with winning the trading competitions, people get focused on how much you can make, not how much you can lose. And I like to keep it real for folks. And also, if you like to trade options, there's a great website here if you'd like to go take a look and learn a little bit more about the various risks of options trading. But with that being said, thank you. I really appreciate you guys being here. I did recently win another international trading competition for most money made over in Italy, and just a few weeks ago, of course, many of you, there was about 205 people that sat in the audience in the Las Vegas Traders Expo and watched me win that competition. So really great time there. So it's a wonderful time to be with you as we're using these strategies in the current markets and having a lot of fun with it. And I know that the sound was breaking up a few minutes ago when the guys were speaking, and hopefully you guys can hear me okay now, though. So I hope my audio is coming over to you. And as we go ahead and start off, just want to go ahead and share a moment. Good, great, gang. Thanks for letting me know. And as we start off, though, I just like to remind people, forget the competitions for a moment. I'm just like you. I put my socks on in the morning. I put my undies on in the morning. I'm just like you guys. These were the actual books I checked out from the library back when I was a teenager. And, it's kind of funny. And I went back and I bought the books from the library. But, I go back and I look at it, How to Read the Wall Street Journal and that. These were the kind of books I was getting, The Language of Wall Street. I was a teenager. What did I know? So those were the first books I had. I had 3 jobs. I had 2 full-time and 1 part-time job. So 2 jobs for a sheriff's department and 1 part-time job. So I worked all this overtime at the sheriff's department, which is basically like a full-time job at the time. And I was also working at a part-time Podunk police department as well. Meanwhile, I had a son at home. I was a pretty young guy, had a son at home. And so I really like to tell all my clients, retail and institutional, like I didn't have a Rob Hoffman to help me through those ups and downs. It was painful, so painful. It was exciting and painful at the same time. And many of you are at that point in your journey now. So what I'm hoping to do through my company, Become a Better Trader, is accelerate that process for all of you. I had a passion for the markets. I still have that same passion for the markets, and I was determined, and I'm as determined as ever. And this is my son. I'm very proud of him. He's a United States Marine. He's here in the United States helping Americans. Recently, you recall, we had the hurricanes over on the East Coast, and he's part of a hurricane response team unit right now when things get ugly, and so I'm very proud of him. And this is my lovely wife and my beautiful little daughter, and I like to show these pictures because, here my daughter's already starting to grow up. This is her at 5 months old. Lovely little picture. Then here's a funny picture of her at that same little 5-month birthday. And now here's her just this past weekend for Halloween. I was speaking over in Prague for an institution and for an exchange over there in a brokerage firm as well. And I said, look, I'll do it for you, but I have to leave Saturday morning because I'm getting back for Halloween to spend with my daughter. I'm not going to watch my daughter grow up, overseas. And they agreed to that. And so I did my great talks for them and came back and got to spend a wonderful night with her at some friends and family's houses there. So a lot of great stuff there. So just like you, but obviously the reason why you want to be here today is because, as the gang said, what I want to share with you is some proven strategies, things that I've used real money in real money trading competitions around the world year after year. And this is kind of the laundry list, if you will. As we talked about here earlier, I've had now 4 international trading competition wins. These are the ones in blue. Just won the one in Italy earlier this year for most money made. And then we also went ahead and had several domestic wins around. I know they're called International Traders Expos, but I like to, they were on U.S. soil, so I like to call them, U.S. domestic wins. And I just had one in Las Vegas a few weeks ago again here. So, what's happening, what's relevant about this, what's important about that, what it means to you is the things that I'm sharing aren't something that I wrote a book about 10, 20, 30 years ago. They're not something that worked 10, 20, 30 years ago. And they're things I'm using year over year over year, as you can see here. Since I started trading and competing in trading competitions, which was my first one back here in 2011, and I've been doing them ever since. These are live real money competitions from around the world, and that's what that kind of looks like. These ones over in France, as you can see here, got 16 traders from around the world that are duking it out, representing their countries, and it's pretty impressive. You can see there's yours truly here with my one laptop, and some of these guys brought 24-inch laptops. They brought multiple computers, as you can see here. They were there to do some serious battle, and I just came with my one laptop and kept it simple. And one of those strategies I'm going to share with you today. So fortunately, again, I was able to win that. And here's some of the examples of some of the profits and what we were able to accomplish during those trading competitions. Very proud of that. Last year, we had a really great time of it. Market was dropping. In fact, the strategy I'm about to show you was very important to me at that time. The market just kept dropping that day in September, so we used this strategy. So you see I traded some DAX, crude oil, and the Russell futures there. About 18 trades over 6 hours. It was a 12-hour competition, but 6 hours of actual trade time. $4,837.20 based on the currency exchange and everything at that time. All right. So with that being said, let's go ahead and talk about what we're going to cover. Thank you very much. That's very nice of you. I appreciate that, Amadi. First we're going to talk about showing a proper setup to even consider a trade. Now I have several different trading strategies, but I want to show you what we're looking for today. For this particular strategy, I'd like to have you guys take away during the special event that Winvesting has put together for you. We're going to identify the price size entries for those trades, choosing the proper trading instruments and time frames there. Now, the good news is I use these, as you just saw, DAX, crude oil, Russell futures, but they can very easily be used, and I do use them on equities for options trades as well as underlying equities. So it's a very diverse application, but we'll talk more about that if you have individual questions on that. And then some simple technicals to determine direction in using this particular strategy. So with that being said, let's talk about the trade that we're going to feature today. It's the Hoffman inventory retracement bar trade. All right, this is one I've written about in international traders magazines. It's one I speak to retail and institutional groups alike. Okay, and yes, absolutely, Chris. Great question. Can it be used on Forex? You better believe it. In fact, I was just speaking for a major exchange, over in Europe, and the focus was on Forex actually. So the short answer is yes. Okay, and as we go ahead, we take a look at this trade. What is this trade? It's a price action based continuation trade. Okay, when do I use it? It's most effective in trending markets. Now I'm going to show you a couple of variations with that, but to kind of just make sure you understand. I had a gentleman in California who I taught this strategy to about 3 years ago, and I usually like to see about a 45-degree angle on a 20-period exponential moving average over the course of 20 bars of data. And so what happened, though, was he started using it as such and doing really well with it. Well, what he started doing was changing the angle of attack to become shallower and shallower and shallower. And this is a trend trading strategy. So what do you think happened when, if it's a trend trading strategy, the more shallow the angle, what do you think ended up happening to his profits versus losses? Do you think his losses decreased, or do you think his losses increased when we focus on a trend trading strategy like this? They very much increased. Okay, his losses, because he was going ahead and taking a great trend trading strategy and turning around and having it go against him more. So the shallower you make the trend, the less likely a trend trade is going to work. So I just like to remind people that. We'll talk more about that as we get into the presentation. And then for those of you that are longer term traders, it can be even better when tied to fundamental analysis. For those of you that are longer term traders here, many of you have sat there and had a a great fundamental story on your favorite stock, and so you decided to buy it. Well, the problem was it just sat there for days, weeks, months, potentially even years, until everybody else realized it was a great trading story or fundamental story. And so one of the best things you can do is if you take a great fundamental story, wait till you get a technical buy or sell signal. That typically is going to be a little bit more effective, and then hopefully you'll sit on dead money a lot less longer because time is risk these days. So as we go ahead and we move on here, let's talk about how we identify the signal bars that we're going to be looking for. And I'm going to just go through the rules, and I'm going to show you lots of examples of all of this. Looking back over the last 20 plus periods for signal bars. Now, why do I say periods? Well, because I'll use this on a 2-minute chart. I'll use it on a 5-minute, use it on a 15, use it on an hourly, use it on a daily, use it on a weekly. Okay, so for my swing trading work, I use it on daily and weekly charts. On my intraday basis, I'm really focused on these on 2-minute through hourly charts. Okay, I'm going to show you some examples of that from this morning, and where we're looking for these kind of things. It's actually a very nice, profitable morning here. So as we go ahead and take a look now, looking back over the last 20 periods, so ask yourself, what time frame do you like to execute trades on? Whatever time frame you're looking to actually execute a trade on, that's the time frame you're going to be looking at. Now, I'll caution you on one thing here. Typically, I do not like to go ahead and use this particular strategy on tick charts or 1-minute charts. Typically 2-minute charts and above. 2-minute charts and above, okay? This particular strategy. And so looking back over the last 20 periods for signal bars where the open and the close of the bar are approximately 45% or more off their high in an uptrend, or 45% or more off their low in a downtrend. So basically what you're doing is you're looking at the bar, asking yourself how much wick is showing on this particular bar. And I'm going to show you lots of great examples of this in just a few moments. Where will my entry be? Will be 1 tick or 1 cent. In fact, let's do this. I want to actually go and show you these bars right now just to make sure you guys understand this. So in a downtrend, I'm looking to go ahead and have the market going down. I want to see it push back up, and then I want to see the market break back down below the low. So really what it is, it's a trend continuation breakdown trade. Now, why am I doing that? Well, the reason why I'm doing that is because I'm looking for places where one or more institutions has temporarily stopped the market from going down, even though we're in a downtrend, stopped the market from going down, and is actually driving the market back up. Let me ask you a question. If we're thinking about, let's say, Apple stock for a moment, okay, if we're taking a look at Apple and Apple's going down like this, and all of a sudden Apple stops going down and then starts being driven back up, is that you or me going ahead and doing that? Or is that institutional participation doing that? And David, yeah, we're going to go back to that last slide. I've got lots to share with you on that. So we'll be going back to that slide in just a moment. You'll be able to take your screenshot and write your information down, okay? So it's absolutely institutional. Let me tell you, back when Apple was a $500, $600 stock, I loved trading Apple. I do 1,000-share blocks of Apple, and I'm here to tell you, never once in all my days of trading Apple with 1,000-share blocks at $500, $600 a share, never once did my 1,000-share blocks move us off the bid or the offer. Okay, so the thing is, when the market is not always stopped, but it's actually driven back up, that's more likely institutional participation. So I'm looking where that short-term buying is taking place, and of course that buying could just be short covering, but there's orders to fill, and typically what you're looking at is iceberg orders there, so you're looking at a series of orders to be filled in that area, and so what happens is it starts driving the market back up, and this causes all sorts of things to happen, which we're going to talk about in a few moments. But what I'm looking for, remember, we're in a downtrend, right? We talked about that 20-period exponential moving average. And now remember, if your favorite moving average happens to be a 19.15694 simple moving average, That's the secret one, by the way. Just kidding. Then it's okay. Basically, just somewhere between 19 and 21 periods, either simple or exponential. Okay, that's what we're looking at. To about 20 bars of data there, and are we basically downtrending? Okay, and so what I'm looking for is I'm looking for a trend. I'm looking for a short-term pullback against that trend, which causes all sorts of dilemmas for retail traders. And then I'm looking for it to break back down into the direction of the trend. That's a downtrend. Now, in an uptrend, I'm looking for the opposite. I'm looking for us to be going up. Then I'm looking for one or more institutions to be selling into the market. Okay, and at that point there, what I'm looking for is where that one or more institutions inventory is no longer there, it's been eaten through, and then the market's free to break back on board the original direction that it was going. Okay, so that's the gist of what we're looking for. So these signal bars are bars in an uptrend that are 45% or more wick on the top side from low to high here. So and these are all 4 individual examples. And the reason why I do that, I want you to see it doesn't matter whether the bar is red or green, thin or wide. What matters is how much wick is showing on the top end of an uptrend or on the bottom end of a downtrend. I want from the high to the low, I want 45% here. To be off the low. Okay. And so so this is a real-time indicator of information where short-term buying or selling is coming in, and then I'm looking for the market to resume back through the original direction of the predominant trend. Okay, so that's what we're looking at there. Now, as we go ahead and take a look, and hey, Jim, great question there. I've gone ahead and won trading competitions against top traders in the world using this strategy, so it's definitely a leading indicator for me. Okay, and so as we go ahead, we look then, where's my entry? The entry tends to go ahead and be 1 tick or 1 cent above or below that signal bar as I just showed you. Where's my exit? I'm a big fan of trailing trades. I didn't used to be many years ago, but over the years I've become a big fan of trailing trades. Most of you, in fact, how many of you have ever had a great trade on, you were making money, but you set a profit target out into the future and it came really close to your profit target, missed your target, and then turned around and become a loss? Anybody ever have that happen here? Where you set a stop out into the future where you're a target and the market's chugging towards that way and unfortunately never quite gets there and then turns right around and becomes a loss. Yeah. And so a lot of agreement there, and I appreciate your honesty. Yeah, that's right, Dan. Oh no, never. Exactly, that's right. So yeah, I appreciate your honesty, gang. And we can all talk about that here. My biggest loss in my trading career was a result of going ahead and having a profit on the board, and wanting an extra about $8,000 of profit on that particular trade, and I didn't trail it. I wasn't trailing at the time years ago, and then I was in a big position, and then the Federal Reserve Chairman came out and spoke and caused a major market move against it. And here, this was a great profit on the board that I could have walked away with and turned it into an unnecessary loss. And since that time, what I've found over the years is that trailing tends to be the split the baby with the bathwater kind of way to do it, giving something a chance to run, but not going ahead and then turning around and letting it become a loss. Because then, of course, what happens after your trade becomes a loss? How did you guys feel? All of you that were honest about it, how did you feel afterwards? Did it make you want to revenge trade? Did it make you get frustrated and maybe perhaps go back in and do something silly or cause emotions that are harmful to your next trade? And that's the kind of thing that we're looking at right there. That's the kind of thing that we're looking to avoid, okay? And yeah, disgust, right, David? So you guys understand exactly what I'm referring to. So as we go ahead and we take a look, I'm going to show you more about trailing stop methodology in just a few moments. I'm going to show you some examples from that. And where's my stop loss? Stop loss is 1 tick or 1 cent be on the opposite side of the signal bar or a predetermined loss value. Now, the reason why it might be a predetermined loss value is because the opposite side of the signal bar might be much further away. For instance, as we go ahead and we take a look at this right here, well, let's just say this is a weekly bar on Apple. This bar from the low to the high here might be $30. Well, back in the day when it was $500, $600 stock, could be way outside the risk parameters that you're willing to have for your risk trading plan, of which hopefully you guys have risk trading plans. And so as we take a look, we're getting short down below. The stop loss is one tick above the high in this case. And the reason being is because, the truth be told, it shouldn't even go back above around the 50% level. Most of the time, it's not even going to go above that. If it goes much above that, something's wrong, and you're probably more likely to actually just get fully stopped out on the trade. Because typically, when you're in a downtrend and you go ahead and have this push back down through this area here, what should happen once that one or more institutions is gone with their trading, once that inventory is dried up, now the market's free to go back on board the original direction. And then typically what you're looking for at that point is a whoosh, is what I refer to it. And it's basically a flushing of price activity, which we're going to take a look at. A couple other things to think about here. The concept of rocket fuel. If it's moved a large range very quickly, the breakout is more likely to fail. And that's why I actually have this bar here to show you. So in a situation like this, where you have a big, long, wide range tail, so it's outside the norm for the average true range, and what's happened is this bar opened up way up here, went all the way down here. Well, now it's already, in this bar, spiked all the way back up to here. Well, guess what? Where is our entry? Our entry is actually 1 tick or 1 cent below the low of this bar. That means now that it's got to get all the way back down to here before we can even take the trade, and then it's got to have enough juice to keep on going. In a situation like that, that's what I call rocket fuel, because the risk is it runs out of the energy just as it's trying to really get going, and that's typically a bad place to enter from my perspective. So what we're looking for here is for the market to actually kind of come down to this area, bounce, and then roll back over and break through the second time. Then that's usually where it's a better place to take a trade after a wide range bar. Typically I like these bars more like in this area right here, this area here, so that you got a good 45, maybe 65% of the wick, of the bar's wick. But when it starts being up here like this, 90, 95% of the bar wick, that tends to be a little bit problematic. Okay, and then also diverse applications. I cannot emphasize this enough. Sure, in trading competitions, in my live trading room, I'll use this trade on 2-minute, 5-minute charts. That's certainly what we were focusing on this morning, and had a pretty good morning, about $950 gross. This is my actual live trading account from trading in the live trading room this morning, so not too shabby. And so I use this live, and in the morning I'm typically using this on like 2-minute, 5-minute charts in the in the trading room. But as I said, make no mistake about it, if you're more of a 1-day, 2-day forex trader, you're going to use this more on like hourly, 120-minute, 240-minute charts. If you're a swing trader, you're typically going to be looking at this more on daily and weekly type charts. Okay, so trail your entries to reduce the risk of reversion to the mean. That's what RTM stands for, and I'm going to be using showing that in a few minutes, how I do that. And then trade in the direction of the BB2 Pro Trader Pack. Well, most of you guys aren't necessarily students of mine already here, so what you could just use as a basic alternative, like we said, is a 45-degree angled 20-period exponential moving average over the last 20 bars. Okay, and again, that's based on whether you're a 2-minute trader, 5-minute trader, whatever time frame you're actually executing on, that's the time frame that you're focusing on. Okay, so the wick, to answer your question there, the wick is basically a representation of price action and support, resistance, inventory orders. And so what I'm looking for is, we're looking for a market in a downtrend where the market's stopped its price action to the move down, and then put this up here right over here. Definitely, Jim. I'm actually going to, yes, rocket fuel, TJ, is another name for exhaustion, and welcome back, TJ. Good to see you as always. And Jim, yes, we're going to actually show examples that I've used to win actually trading competitions as well in just a few minutes. Okay, so that's what I said. You're going to see lots of examples there. I'm just trying to get you the foundation first before we move forward. All right. And so those were a couple things that I wanted you guys to think about. Now, let's go ahead and go into the charts here and take a look. All right. So here we have a trend to the downside. This is a weekly charted trade station. This is a daily charted trade station. I like to show this because in my free nightly videos, I went ahead and I was talking about this as this whole thing was unfolding and happening in Apple, and so it's kind of a matter of public record there. And so what happens is we have a downtrend. Now what I'm looking for is a bar that comes back 45% or more off the low. So here you'll see one of those examples. Now notice what happened. Okay, notice what happened, and Jim and all of you that were asking about what these bars represent, what they mean, and a little bit more about it. Take a look what happened. So the next few weeks, 1, 2, 3 weeks, it goes up from that area which stopped the market cold, and there was enough inventory to actually drive this higher. Notice what happens when it pops back down here. What does it actually do, gang? It sits there for 2 more weeks. Why did it sit there for 2 weeks right at that level where the market stopped going down before and was driven up? Why is it now sitting there? Because there's still inventory, right? That's right. So those orders have not all been filled. There's still institutional support. Exactly, gang. Okay? So with that being said, as we go ahead and, hey, Sean, I think you might have confused me with somebody else, actually. So as we go ahead and take a look at this, so it initially pops up from here. Now, I have trading strategies for those of you that are familiar with my work, lots of great things like stochastic spikes and such to go ahead and capture moves on the upside. But the setup that we're sharing today is focusing on this. We're not focused on the stochastics here at all today, Cameron. So today we're focused on price action and then trend. So here you got your 20-period exponential moving average and price action bars, something that you can all take away today. All right. So what happens here is once that inventory is finally eaten up over here, what does the market do, gang? What does everybody see it do over here? So it spikes up from this area where we had the inventory retracement bar, comes back down there, sits there with inventory for 2 weeks, and then once it breaks down below the low of that inventory bar, what does it do? It whooshes to the downside, drops over $30 that week. Okay? Now, this is also another great reason why I want to trail stops. I'm going to show trailing in just a few moments, where we identify a key support or resistance level, of which, for instance, the round number support is going to be a key area in, like a stock, $100, $200, $300, a lower price stock, $10, $20, $30, $40, $50. Those round numbers are going to be very important support resistance levels. So let's go ahead and go back over here now. So here we have another one of these bars, right? And then what happens is we see another one of these 45% or more off the low. We're still in a downtrend here. So notice we're looking basically over the period of the last several bars. So it's not just 1 or 2 bars, and we're saying, oh, the exponential moving average is in a downtrend because the last 2 bars were. We're looking over the last 20 bars of data there. And now we're looking to break down 1 tick or 1 cent, in this case cent because it's a stock, down below the low. Now what does it end up doing there over the next 3 weeks? After it breaks down below that low, the rest of that week, and then the next few weeks afterwards, spikes down $30 again. You guys following me? And actually, technically, it went down more, but it hit that $400 round number support level, and then bounces off here. Okay, so once we break down below these levels, where that short-term inventory presents itself, where 1 or more institutions temporarily holds the market up, we're looking for that inventory to exhaust itself, and then the market is free to go back on board the original direction. Okay. Now here's a daily version of the same time frame right over here. And this is what I was pointing this out as this was happening, with Apple at the time. So here we are, and it's hard to see now because what happened was it spiked down so hard afterwards. But this was actually a nice trend to the downside. We had a bar as 45% off the low here. And so what happened over the next several days, what did it do? So here's the low, and then what did it do for the next several days? It sat right at that level. Can you all see it? It's right there in front of you. I want to make sure you guys can see it. So here's the low of the bar. So it sat there for the next few days. Okay, and look what happened. So it sat there, it was eating away at inventory. Sat there, was eating away at inventory. Sat there, was eating away at inventory. Then it finally pushed through because the market was in a downtrend both on the daily and the weekly basis. So the next higher time frame was with us as well. And then what did it do from there? It went here from the 430 area right on down to the 390 area. It dropped $40 over the next several trading days. That's the same time frame right here. So not only did you have this happening on the daily chart, you had it happening on the weekly chart at the exact same time. Same inventory retracement bars were presenting itself. And look at the power of the move over the next several days. $40 drop in Apple at the time. So just shy of a 10% drop right there. Okay? So let's go ahead and let's talk about what's happening here. Because I want you to start thinking more like an institutional trader. Then I want to get back and show you a lot more examples and also how I trail these trades. So there's buy-side and sell-side mistakes that most of us as retail traders make, okay? And so let's talk about the sell side for a moment since we were just looking at Apple. What's happening in a downtrend is these bars that pop back up like we just saw a few minutes ago, they'll start to make traders not want to sell, okay? How many of you have ever seen a market where it was going down and you were thinking about going short, but then all of a sudden you had a little pop-up back the opposite way and you're like, oh, good thing I didn't short. And so you moved on, you went to the next trade, to the next stock, the next futures, you moved on, and then all of a sudden you look back a half an hour later or a day later or a week later, depending on the time frame of trading, and all of a sudden it went your way and so much more. Anybody ever have that happen here? Where you had the right idea, it's just that the market happened to go back the opposite way for a little bit. You started getting concerned that this was actually going to be a reversal because then you start thinking about those losses that you had, right? David, I'm assuming that means this is applying to you in a big way. And so what happens is it's going back the opposite way, right? And so you're like, oh, good thing I didn't short that. This would have been another one of those losses, right? But then all of a sudden you turn around and next thing you know, it's so much lower. And you're like, oh, man, I knew it was going to go that way. Dang it. That's not fair. Okay. Well, so now what happens? If you missed the initial trade, it distracted you from wanting to sell when it popped back. And so what happens then is you finally decide, well, that's not fair. I missed the money here. I missed it here. I missed it here. I missed it here. They're not going to make me lose any more money. I'm going to take this trade. And then this goes ahead and so what happens is they finally jump in the trade late. And then what does it do? It goes right back up. And you're like, how come every time I get in a trade, I lose money? Right? It feels like you're always the last one in, and then they turn it around. But yet you were right on the trade earlier. So what's happening is those moves back are stopping out the late sellers. It's distracting the initial sellers from wanting to sell, and it's also giving false hope to the buyers up above. How many of you here have ever gone ahead and been that trader who thought the market was reversing, so you decided to go long, only to sit there and have it start to go back down against you, and then what happens is it goes ahead and starts going back up towards your direction a little bit. You're still losing money, but it's going back your way, and you start cheerleading it. Yeah, go back up, just a little bit more, right? And so what's happening is that little move up, so you buy up above because you think that the market's reversing here, and then it goes down. That little move up gives you hope that it's actually going to turn around and go back your way, and then all of a sudden it goes down, and it goes down even lower, and now you turn a small loss opportunity into a big loss. Anybody here know what I'm talking about when I say all that? Sound like anybody familiar here? Anybody want to be honest enough to admit it? It's okay. We're all traders here. We've all done these things at some point, gang. So I appreciate your honesty there. So we're all in this together. This is not uncommon, and so what's happening here is these kind of things, and that's why I'm trying to get you to understand when you're seeing these bars. I want you to start looking at these bars differently. So in other words, when you see a bar like this, I no longer want you to say, ooh, good thing I didn't short, and then be more of the hunted. I want you to sit there and say, hey, well, let's see, market's still going down. Okay, here's my plan. If this thing breaks down below here, I'm going to consider taking a short. Okay, and I want you to start thinking more like the hunter, not the hunted. All right, and I'm going to show you, more great examples of this in just a few moments. So so what happens is, here's the other beauty about this. As long as you keep having those bars, you can keep taking those shorts at the next level below, as long as you still have the trend. So if it happens to be one of those situations where you miss a good trade, well, the next good trade is just right around the corner, okay? And so that's something to go ahead and keep in mind. If you miss it, you happen to have been hunting it, and then you went away on vacation. If you're a swing trader, you had to use the restroom, got distracted by your husband, your wife, your kids, grandkids, whatever the case may be. The next good trade is just right around the corner with this, so don't feel like you have to chase it. Okay, a couple things to keep in mind there. So, and then like I said, this institutional slide, very, very important. I want to get you thinking like the hunters, not the hunted going forward. Okay, a couple things on trailing stops. So here's how I like to do trailing stops. I always pick a price into the future that I'm looking at. Now, in my case, that can be a daily, weekly, or monthly pivot, as it was in this case right here. Or if, for those of you, we heard a previous speaker talk about Fibonacci numbers. If you like Fibonacci numbers, that's great. You can use a Fibonacci extension, for instance. Whatever your favorite numbers, I also share with you about, like, for instance, this is a currency here. This is the Japanese yen. So, round number support and resistance levels. The euro, for instance, right now, the 110 level, the 109 level, the 108 level have all been very important the last few days. So, a stock, like when we showed the example with Apple here a little bit, the $400 level. Here back when it was, once it split and it was under $100, the $100 level was very important to it. Okay, so pick your target there. A lot of times I use daily, weekly, monthly pivots. All right, so that's what we have right here. So what happens is I'm going to look to take the trade, and then once we get about 50% of the way to my target, I want to trail up by about 50%. Now, watch what happens though as we get up closer to my target. Instead of just hoping that it's going to get up here with a fixed stop for my target, what did I do with the trailing stop? I moved it up to about 80% is how my methodology works with that. Why? Because what's more likely to statistically happen, gang? Is it more likely after it's been going up, up, up? Is it more likely to go ahead and just keep going up, up, up forever here? Or is it more likely to hit that major resistance and stop and reverse? It's more likely to pull back. Exactly, Jim. So as we go ahead and we take a look here now, let's move forward. So as we're actually hitting my target, okay, now you'll notice I don't have that fixed stop. I don't have the fixed stop because if it does hit, 1 out of 10, 1 out of 12 times, it will pop up through here for a quick pop, and then it will roll back over, those false breakout type trades. So so what we're looking at here is a situation where from my perspective, I'm going to give it a chance to run, but if it doesn't, I'm going to make sure I'm locking in profit. So look what happens here. This trade here went ahead. It was at 90%. It wasn't breaking through. Now, so at that point, it just gets moved up right under price. Why am I going to give it a chance to roll back, and then you're taken out of the trade? Okay, so that is an example of how I trail. So just to repeat that real quick, I identify my target out into the future, whether it's a Fibonacci extension, for those who like that, whether it's a daily, weekly, monthly pivot, a round number support level, depending on the instrument types of instruments you trade. There's going to be some obvious ones with the instruments you like to trade, and then I trail up accordingly. Okay, now let's go ahead and take a look at a couple competition winning examples here. So this is one. So these ones here I'm showing you now were all from Paris, France. These were live examples of trading competition wins that I had over in Paris. Okay, so I want to look at this with you. So what happened here was the market was initially sideways back here and started bowing to the downside. It started going to the downside here. So this was the first bar that I felt comfortable with as the trend was accelerating. I had some other indications here. You see, I was going red on some of my advanced indicators as well, in addition to the 20-period moving average starting to roll over. And so what happened was this was the bar that then was my signal bar. That was my inventory retracement bar. But do I take the trade on that bar? No. What I need to do, I need to actually wait then until we break down one tick in this case, since this was a futures contract, one tick below the low of this bar. Now, what did it do afterwards? So these are 2-minute bars, by the way, because it's in the middle of a trading competition. Each round lasts about an hour and a half. So what did it do afterwards? It whooshed to the downside. Do you guys see that? Over the next 6 minutes, it dropped $500 a contract. So you see here, here's the inventory retracement bar, 45% off the low. The next bar breaks down below it. That's the bar I get short on. And then right after that, it dropped about $500 a contract. Okay? Can everybody see that before I move on? Here's the bar. Here's the entry, one tick below. And then it whooshed. And that's what I said. The normal anticipated result from this is a whoosh. Okay? Or I got that. So that's why I said when I told you a little bit ago when it came to stop losses, I said the next bar, once you're actually into the trade, shouldn't even go back more than 50% of the signal bar. If it does, there's an even higher probability it's just going to go and become a full stop out. Okay, something's wrong with the trade, because what should happen once that one or more institutions stops the market from going down against the trend, and then their inventory is gone, the market is free to go back on board the original direction. Does that make sense, everybody? So I'm going to move on there. Okay, so here's a great example. So I didn't show you the slides for this from the competition, but like as we got later in the competition, I was having anywhere from 2 to 3 judges standing over me. And they're constantly checking. Are you trading? Are you trading? Because you got to declare and show your trades live in real time. Everything is live on the screen. It's live accounts, live money. All trades are called out, shown live, and validated with the time and stamp seals. So everything is as live as get. So here was a great example of this. I had all these judges, which can be a little bit distracting, as you can imagine, when you have several judges standing over you. So here was a bar. The market was coming down in a downtrend. Can everybody see that bar? 45% off the low or more? Everybody see it? So what's nice about this is, whether this is a 2-minute chart, a 15-minute chart, a daily chart, a weekly chart, what's nice is once you see this bar, okay, then what you can do is you can go and put a sell stop order, in this particular case, 1 tick or 1 cent, in this case 1 tick below the low. Okay, and so what was nice about this is I was actually able to talk to these judges about 18 minutes in advance, because what happened, notice what happened. The market stopped here. It got driven back up into that falling 20-period moving average resistance. Okay, and again, I've got great trading strategies for that, but we're not talking about those particular ones today. What happened was it pushed back up into the falling resistance, and then it started to roll back over. What did it do once it broke one tick below the low of this bar here? You better believe it. Exactly, Jillian. It whooshed. Absolutely. Okay. So the bottom line is what we're looking. Amadi, remember I trail these trades. I trail those. Yeah, that's the technical term. Well, the reason why I say that is because what I want you to get in your head, right, Jillian? I want you to get in your head the expected, anticipated result. Because here's what happens usually. If I get a misfire, and what I mean by that is I get short and then it only goes down just a few ticks or something like that, a few cents, it just hangs there. That is not the anticipated result that I'm expecting. So then I'll usually just look to take a quick profit on that. Okay, what I'm looking to do is actually have it whoosh back into my direction. All right. So the Cynthia asks, what about the higher time frame to determine the trend and increase the trade winning probability? Cynthia, you better believe it, girl. You want to absolutely go ahead. So, like for instance, when I look at taking trades on my 2-minute charts, I'm usually looking to the 5-minute chart, seeing if the 5-minute chart agrees with me. If I'm putting on a swing trade on a daily chart, so like for all the people that are part of my swing trading alerts, my swing trading videos, and all that stuff, what happens is I'm usually showing them the weekly chart too. I'm looking for a weekly confirmation. Okay, in my opinion, you are definitely going to increase your probability of success if you have the next higher time frame with you as well. Okay. Um, and let's see, how do you know when it's 45% or more off the higher low? Or are you eyeballing the tails? Yeah, so it's real easy. Once your eye, it's like anything else, gang. Once your eye gets trained to look for them, you can spot them very quickly. And I also have indicators that just kind of point it out for me as well. But it becomes real easy to spot them after just a few hours of looking for them. Okay, so that's why I'm giving you some examples to look at, study, and then go back to your own charts and start looking at studying. You'll be surprised, Troy, just how fast you get there. Okay, so as we go ahead, and let me move on here too to keep going on schedule here. Appreciate the Winvest in people having me today, and hopefully this is helping a lot. Certainly a lot of people participating there, so hopefully this is making a lot of sense for all of you. So then what happens is, remember what I said about can you get back into another trade? All right, well what happened on this was this thing whooshed to the downside, and I was going ahead and trailing. All right, well eventually then as it starts to pop back up, you're going to get taken out, right? So the question is, whether you got taken out early, you got taken out late, whatever the case may be, is irrelevant. What is relevant is if the conditions are still there. So in other words, I still have that nice downtrend, and I have those bars that are approximately 45% or more off the lows. Can I get into another trade? Okay. And the answer is yes. Okay, the answer is yes. So you can get into the next trade. And that's exactly what I did. These blue vertical lines are the bars that I entered the trades. The red lines represent where I was looking to get short, which was one tick below those red lines. Okay, so look what happened again after I got short again. What did it do? It whooshed to the downside here once again. Can everybody see it? Okay, so that's what we're talking about. Okay, yeah, Jim, 45% off the lows in a downtrend, we're looking to short. 45% off the highs in an uptrend, we're looking to go long. Yeah, yeah. No, that's good. I'd rather have you ask Jim to make sure that you're on the right side of the understanding of it. Okay, and so here's another trade. This was crude oil at the time, and so so crude oil went ahead and was pushing to the downside here. Okay, in the backdrop, it's hard to see the 20-period moving average, but you can certainly see my channel was trending to the downside. So we were in a downtrend there. You'll notice here's the bar, 45% off the low in the downtrend. Well, so where's my entry? One tick below the low of that. And what did it do afterwards, gang? What did it do? That's right. It whooshed. Okay. You got it. Okay. All right. And hey, you know what, Amadi, I don't understand that particular question. What's the difference to a trend change where there are also big wigs approaching? So maybe if you just retype that for me, Amadi, I'll be happy to try to take a stab at that one for you. Okay. Is there a whoosh on the upside there? I bet you're referring to this one right over here, Jillian. The answer is yes, but that would be taking the uptrend trade in a downtrend. That's not what we're looking to do, is it? Okay. So, yeah. All right. So let's think about this again. No, you're very welcome. So let's think about this again. What we're trying to accomplish is we're trying to avoid these retail trader buy side and sell side mistakes. In the uptrend, right? In the uptrend, it's a similar situation. The market's going up, up, up. All of a sudden, it has a pullback. That distracts the buyers from wanting to buy, as many of you said that it does for you. Also, the traders who waited for it to go up too far, and then it starts pulling back, it stops out those Johnny and Jane come latelys to the trade. And then, of course, the traders that shorted down here that watch this going against them, going against them, going against them, it starts coming back down a little bit towards their position, even though they're at a loss, and they start cheerleading, yeah, yeah, go down, go down, go down. Well, then all of a sudden it goes back above that short-term institutional inventory level, and then bam, it's free to take right back off the original direction the market was going. Okay, and there's no doubt. TJ says seller's false hope is the worst. It is. It's painful because what's happening is you're at a loss, right? So you're short. And this thing is coming in, and it's already going against you. Well, then it starts coming back your way. And see, what traders should be thinking is, you know what? I'm just going to trail this loss down. I was wrong on the trade. I'm going to trail this loss down. And the moment this turns back around and starts going back up, I'm just going to take the loss. That's not what they think, though, is it, TJ? What they think is it's going to keep coming my way. It's going to keep coming my way. Maybe I can actually make money on this trade still, even though I was originally wrong. And so then what happens is it goes back up, not only becomes a loss, but then it becomes a super loss because once it gets back above that inventory level, it's gonna blow up like we just showed you. It's gonna whoosh. And now what they've done is they've turned a small loss opportunity into a huge loss. And then you start saying, oh, I should have just taken the small loss. How many here are willing to admit you've done that before? So you can see these are the key mistakes. I appreciate the honesty from all of you that have been honest enough to answer, and hopefully this is making a lot of sense. Then you kind of go back and reflect on this. Dion, that's funny. Hopefully you can then, kind of take a look at this. What I'm trying to, do here. Yeah, no, and I appreciate it, gang. And listen, as I'm sure you understand, I'm not trying to get you to admit these mistakes, just out of pure admitting your mistakes. I'm trying to get you to see and reflect on what you were doing and then giving you a different way of going ahead and thinking about these markets so that you can say, hey, those areas, sure, the market is there, it got you. But now start getting your mindset to think more like the hunter versus the hunted. Just like I did in that trading competition. Like, think right back over here. I was the hunter. I saw this bar. I was able to go out there 18 minutes in advance and say, hey, refs, I got an order out here to short. And then just sit there. I just sat there waiting for this to go ahead and roll back over and break through. I'm like, there it is. Okay. And so I was the hunter, not the, oh man, I'm glad I didn't take that trade. That would have been another loser. No, I'm not sitting there thinking that way. I'm sitting there thinking, oh, there's my setup. I got a great trend. I'm waiting for another trade. Okay. See, that's why I'm trying to get you to think about that there. Okay. Um, And let's see. Can you Richard asked, can you reiterate the minimum angle of 20 EMA? Presumably looking at flat location of price doesn't matter. It's all about quality, not quantity. Yeah, so that's exactly right. So let's use this blank screen for a moment. I would prefer 45-degree angles. I'm going to show you in a moment how you can do it with lower angles of attack, but the lower the angle of attack, the higher the risk of it not either following through with a whoosh or the higher risk of an outright reversal against you. Okay, and so from my perspective, I would prefer traders stay in that 35 to 50, 35 to 55 degree angle of attack there to the downside. Okay, as it starts shallowing out, people start getting to 30%. Here's the problem with 30%, Richard. They still see success with it. And so the problem is, though, what's waiting right around the corner for them is them to shallow at 20% or 25%, 20%. Next thing you know, their losses start going up dramatically. And since unfortunately most retail traders tend to lock in gains too quickly for small profits and then let their losses run. Well, when you go ahead and you start shortening it down here and you start increasing your probability of losses, that hurts. You understand what I'm saying? And so that's why I prefer to go ahead and keep people focused, ideally, as close to that 45-degree angle as possible. And I said, that guy from California called me 3 years ago. He's like, Rob, I don't understand. This trade of yours used to work, and now it's not working. And I'm like, well, I don't understand. I keep winning competition year over year over year with this competition. I'm using this in my trading room. I'm doing a great job with it. I don't understand. And so then I look at his screen. So, and next thing you know, I see that he's taking trades where he's basically sideways. Okay. And so, kind of going back over here, let's just take a look at this one more time. We've got a downtrend in place. All right. And so we've got a downtrend in place. We're looking to break down below those bars. We expect a whoosh. Okay. Let's see. So remain on a pullback within 30 to 48%. Yeah, I would definitely stick 30% or greater. I prefer, like I said initially, even more, in my opinion, Jim. Stick closer to 40%, 45% to start. You can start getting cute with it later, but get the methodology right first. Does that make sense? Let's see, John H. Been there, done that in all of your examples of trades working against you. Rob, you're awesome. Thanks for sharing real trading plans, actual charts. You rock. Well, John, I hope for you and for everybody, this is making a lot of sense here. So as we go ahead and we take a look, we've talked about these institutional mistakes. This is what I want to get you guys thinking, so that you're thinking more like the hunters, not the hunted anymore. There's different ways to take these trades. These are more examples of trades on daily charts of equities, and so you can just see over and over again the bars. I just want to give you more examples and different time frames here, and then this is great because you can combine it with different trades of mine, like my stochastic spike trade, and you see right here. So we had a stochastic spike trade, so that's a great sell signal, and right after that, there's my inventory retracement bar. Hopefully, you guys can all see it. The very next bar, right there. There's the inventory retracement bar. Gang, what did it do as soon as it broke one tick below the low of that? I made $250 on one contract on the trade. What did it go ahead and do right after that? I just got done in Barcelona, Spain, teaching a class on this. Went right back to it, took the trade. So that's why it's fun to show that right after you teach a class on it and do it. So what happened? As soon as it broke down one tick below that low, it whooshed. Drop 40 ticks like a bad habit. Okay, so in summary, there's different ways to use this. You can use it with more flat moving averages, as we talked about, but that does decrease your overall probability of success. I prefer you guys keep the nicer angles of attack on the moving averages. I feel like you're going to have higher success with those. But I wanted to kind of show it to you there. Also, don't forget, this is inventory. This is institutional inventory. And what's happening here, until that inventory is broken through, it is inventory. One or more institutions has got stuff to sell there, okay? So look what happened here. It spiked up, made the inventory retracement bar, spikes back into that area, got killed off. Spikes back into that area, got killed off. You know, an hour later, spikes right back into that area, and there was still inventory there, and the rest of the day, it couldn't get through that area, okay? So remember, these inventory retracement bars are inventory until broken. Now, you know, what I just really want to say to you guys, you remember this guy? You remember me at the beginning? Well, gang, that was me in that police uniform, and at the time, I couldn't have imagined that one day I'd be sitting here in front of you, I'd be trading for a living, teaching people all over the world to trade, winning against top competitors and top traders around the world with real money. I'm really thankful. I'm blessed. You guys have been nothing but wonderful to be here with me today. I appreciate you coming to spend time with me. And, you know, what I'm going to do real quick, if you don't mind, I'm just going to show you a simple way to get started with me and to learn to trade my setups that you can start using now. What I have for you today, if you guys go to becomeabettertrader.com/setups, becomeabettertrader.com/setups. What you can do for $97, just $97, I'm going to give you 2 more setups of mine, and it's a 3-part video series. This is really great. What I've done now over the last year, I've added part after part after part to this 3-part series. I use this trade over and over again. I used this trade this morning, actually, in part to go ahead and make that $950 gross profit that you guys saw on the board. I specifically used that trade to go ahead and help me. Okay, here it is right there. There's my gross profit from the live trading room this morning, $950. And right over here, I don't know if you guys can see it. Right over here was one of those trades that we were focused on this morning. So I've got this great 3-part video series that we've created, and what I want to do, I want to give you guys all something that you could take away that's very meaningful to me. Like I said, I spent a year putting this together. I had part 1, then I had part 2, and now I've made part 3 in very simple fashion here to go through entries, exits, profit stop management, settings for the indicators. So basically, I've given you the settings for the indicators so that you can use it on any platforms that you want. Yeah, this is called 2 simple setups for all markets, because I use this in equity trading, I use this in Forex, use this in futures, I use this in my live trading room. I use it in my live trading room this morning. Okay, and so what it includes 1 conservative trade setup, 1 aggressive trade setup, the specific entries, exits, stop, and profit management techniques. And the reason why I do that is to help all of you, regardless of whether you're more conservative traders or aggressive traders, find these award-winning entries in your personal trading plan based on your personal trading style. Okay, so that's really important because everybody's a little bit different. You know, I've been doing this for many years. I'm willing to be more aggressive, so I've got aggressive setups, but then I've got students I teach all over the world that are brand new to me, and I have to focus on conservative trades for them as well. And so, you know, that's really important to understand. This is not just for intraday traders. I can't emphasize this enough. This is for end of day. I've made some fantastic end of day, calls, in fact, I do these in my videos for you guys quite regularly, and this is one of those setups and strategies that I use in there. So it's for intraday and end of day. This way, whether you're a full-time trader like myself, you can get a lot more trading opportunities. But if you're a part-time, more swing or options-based trader, you can easily set these up while you have your second career using this methodology. It gives you instant access to the course work there. Gives you instant access to the indicator settings, the ideas and strategies that I don't normally share in the public. And this is going to be help you be ready for the rest of 2015 and right into 2016. So you don't have to have any proprietary indicators. I'm going to give you the settings for the indicators that you have to use, and no, it's not just that 20-period exponential moving average. Definitely it's more important stuff than just that. This is just basically so you can have an advantage, and I can have you trade and think more like the hunter versus the hunted. So if you go to becomeabettertrader.com / setups, that's going to go ahead and be important. In fact, I suppose myself, I can put that into the chat box for you there as well, gang, so you guys can all grab that. So if you go to becomeabettertrader.com/setups, I just posted that for all of you. That will help you. All right, so it includes a lot of value, 3 parts to the setups, and the entries, exits, profit management, stop management, the settings for the indicators. And again, I'm really proud of this because it's a year-long project where I did 3 different parts for this, over the course of last year, and I'm continuing to use it. I just used it this morning, which, like I said, in part really helped me, with those wonderful profits in my trading room. So I hope that makes sense for you. I hope everything I've shown you today with the other setup, which is the Hoffman Inventory Retracement Bar that I share with institutional as well as retail clients and have written international articles on, I hope that's a benefit for you. As you saw, I actually had the setup just a few moments ago, how you saw the combination of one of the other strategies tied in with the inventory retracement bar. I showed you from Barcelona, Spain. You saw the two back-to-back. Well, that's the kind of thing that I want you to build on with this additional 3-part 2 simple setups course, okay? So I'm just trying to give you lots of value, make it worth your time to be here, make it worth your time to realize that we have the real value. It's not just about me winning these competitions around the world. It's about what that means to you and the precision of my work and the advanced nature of my work and why you need these trading setups as part of what you do, okay? So that's right, John. Okay, I see. John says question answered. These are not proprietary indicators. No. So what I have is I have 3 parts to this. Part 1, I share what it looks like with my regular trading setup, including proprietary indicators. Part 2 and Part 3, it's strictly no proprietary indicators at all. See what I'm saying? So it's a really nice 3-part course. So if you want to see it exactly how I use it from day to day with all my tools, you get to see it there. If you want to see how I use it when I'm just going ahead and using bare bones charting packages, then I show you exactly how to go ahead and use it in Part 2 and Part 3, strictly using the non-proprietary indicators, which is so great. In fact, the proprietary indicators aren't even on the screen. So, it's really great stuff there. All right. And let's see, end of day, yes, it is so important. Inventory retracement bars can be used not just on intraday, but on end of day. In fact, I tried to show that to you. I showed you both examples of inventory retracement bars on daily and weekly charts. In fact, I just had a really great buy signal on Apple back right before the earnings. So on Thursday, right before the earnings, they had an inventory retracement bar. I issued a buy alert on there. It spiked up the very next day up to 119. That was a great overnight profit for my students that took advantage of that trade as a trade alert that I put out for. So absolutely, it's not just an intraday tool and technique. That's an end of day as well, as is these additional 2 setups that I'm sharing here. Okay. And Jim says, I bet you're really glad you're not putting a police uniform on in this environment. Yeah, you know what? It was bad even back when I was a kid. I was a 20-something, right? Unfortunately, even back then there was a lot of tough things going on in the world. You remember Rodney King and all that other stuff. All that stuff was kind of going on back in the day. I tried to actually get into the military, and unfortunately my eyesight wouldn't allow me to. So I was trying to follow my father's footsteps, and so it's like, well, I couldn't get in there, but the police said, hey, you got 20/20 vision with corrected lenses, we'll take you. So I just worked all that overtime that I possibly could. I worked the full job. I worked all the court overtime duty that I could. I did everything I possibly could. And I was raised in a son. It was tough, gang. It was tough. And that's what I'm saying. I'm just like you, but I work with traders. I just spoke for major exchanges and brokerage firms in Europe here. Got back Saturday just in time to be with my daughter for Halloween, but I travel all over the world speaking to top institutionals, and so I know what it takes. And trying to teach you to be more of the hunted versus the, or the hunter versus the hunted. That's what's so important here, to get your mind shift. And we talked about those key things, and that's what each of these setups I'm sharing with you are specifically designed to go ahead and, like the one I shared with you for a little bit ago, the inventory trace bar, it's designed to get you in after the market has stuck it to the retail traders, not you be in the middle of it, kind of not working out so well for you. So, so does that make sense? Okay. And so, gang, I just really appreciate you guys being here with me today. I appreciate Winvesting for having me. I appreciate you guys being awesome and asking all those great questions. I try to answer them all for you. Hopefully, you've enjoyed what we shared with you. This class I did here was basically an hour long for you. The Two Simple Setups class, I believe, was like 3.5 or 4 hours long. 4 hours long is, I believe, what it is now with these three different parts. So, if you liked what you saw here earlier, you're going to love, what I have with these additional setups for you. And it's just a great way to get involved and see all the value that I have to offer you. Okay, and so I really appreciate this, and thank you, the Winvesting team. Thank you again for having me today. You got a great group of nice people here, and I hope that this was a benefit to you and to them. Thank you.